Welcome back to Passive Income Journey 777. Today, we're diving into a topic that's super important for your personal finances: how to lower your tax bill in 2024. Now, I know what you're thinking. Taxes aren't exactly the most exciting thing to talk about. But trust me, understanding how to legally reduce your tax burden can put thousands of dollars back in your pocket. Money that you can use to invest, pay off debt, or just enjoy life more. So, whether you're a seasoned investor or just starting out, this video is for you. We'll be covering some of the top strategies you can implement to keep more of your hard-earned money. Make sure to stick around until the very end for a bonus tip that could save you even more. Let's get started. The first thing I want to emphasize is the importance of tax planning. A lot of people think of taxes as something they only deal with once a year when it's time to file. But that's a huge mistake. Tax planning is an ongoing process that should be incorporated into your overall financial plan. Just like you wouldn't wait until the last minute to start saving for retirement, you shouldn't wait until April to start thinking about your taxes. By planning ahead and taking advantage of the strategies we'll discuss today, you can potentially save yourself a significant amount of money in the long run. Think of it this way: the earlier you start planning, the more options you'll have and the better positioned you'll be to minimize your tax liability. Now, let me give you a real-world example of why tax planning is so powerful. Let's say you invest $10,000 in the stock market and earn a 10% return. That's a cool $1,000 profit, right? But here's the catch. The government wants their cut too. Without proper planning, you could end up losing a big chunk of those earnings to capital gains taxes. However, with a little bit of foresight, you could potentially reduce or even eliminate those taxes altogether. That's the beauty of tax planning. It's not about avoiding taxes altogether. It's about strategically using the tax code to your advantage. Remember, the tax code is complex and constantly changing. What worked last year might not work this year, so it's crucial to stay informed. One of the best ways to do this is to subscribe to reputable financial channels like this one. We're constantly updating our content with the latest tax tips and strategies to help you make the most of your money. Another great resource is a qualified tax professional. They can help you navigate the complexities of the tax code and develop a personalized plan that meets your specific needs. Think of it as an investment in your financial future. Now, let's dive into some specific strategies you can use to lower your taxes in 2024. One of the most powerful tools at your disposal is retirement accounts. These accounts, like 401(k)s and IRAs, are specifically designed to help you save for retirement while providing valuable tax benefits. There are two main types of retirement accounts: traditional and Roth. With traditional accounts, your contributions are tax deductible, meaning you can lower your taxable income in the present. The money then grows tax deferred, and you only pay taxes when you withdraw the funds in retirement. Roth accounts, on the other hand, offer tax advantages on the back end. Your contributions are made with after-tax dollars, meaning you don't get a tax deduction up front. However, the money grows tax-free and you won't owe any taxes when you withdraw the funds in retirement. So which type of account is right for you? It depends on your individual circumstances and whether you expect to be in a higher or lower tax bracket in retirement. If you anticipate being in a higher tax bracket later on, a Roth account might be more beneficial. If your employer offers a 401(k) plan, especially if they offer matching contributions, it's generally a good idea to contribute at least enough to get the full match. That's free money. In addition to 401(k)s, you can also contribute to an IRA, whether you have a workplace retirement plan or not. These accounts have lower contribution limits compared to 401(k)s, but they still offer valuable tax benefits. Remember, the earlier you start contributing to retirement accounts, the more time your money has to grow tax-deferred or tax-free. Plus, you'll be reducing your taxable income in the present, which can lead to significant savings over time. All right, so let's dive into the wonderful world of tax deductions and credits. These are like those awesome coupons you find that actually save you serious money, not just 50 cents on a bag of chips. Now, before you get overwhelmed, let's simplify things. The main difference between a deduction and a credit boils down to this. Deductions lower your taxable income, while credits directly reduce the amount of taxes you owe. Think of it like this. Deductions are like getting a discount on an item before tax is calculated, while credits are like getting money back after you've already paid. Both are incredibly valuable, but credits pack a slightly bigger punch. First up, let's talk deductions. One of the most well-known deductions is the standard deduction, which is a fixed amount that everyone can subtract from their taxable income. But here's the thing. You can often save more by itemizing your deductions. Itemizing basically means listing out specific expenses that you can deduct. This could include things like mortgage interest, property taxes, state and local taxes, up to a certain limit, medical expenses, and even charitable donations. Now, I know this might sound a little complicated, but trust me, it's worth taking the time to see if itemizing makes sense for you. It could potentially save you thousands. And hey, if you're not sure where to start, don't worry. There are plenty of resources available online, or you can always consult with a tax professional. Now, let's move on to tax credits. Remember, these bad boys directly reduce your tax bill dollar for dollar, so they're incredibly powerful. Some popular tax credits include the child tax credit, which can put up to $2,000 back in your pocket for each qualifying child, and the earned income tax credit, which is designed to help low to moderate income families. But that's not all. There are also credits for education expenses, energy-efficient home improvements, and even for adopting a child. Seriously, the list goes on. The key takeaway here is that tax credits are essentially free money from the government, so it's crucial to take advantage of any and all credits you qualify for. It's like finding a $100 bill on the ground. You wouldn't just leave it there, would you? Now let's talk about something that not only benefits you financially, but also makes a real difference in the world: charitable donations. You know, that feeling you get when you help someone in need? It's truly priceless. Well, the IRS actually rewards you for that with some sweet, sweet tax breaks. When you donate to a qualified charity, you can deduct a portion of that donation directly from your taxable income. This means you'll end up paying less in taxes overall, which is always a good thing. It's like getting a little something back for doing good, and who doesn't love that? It's a win-win situation. But here's the thing. Not all donations are created equal when it comes to taxes. You need to make sure you're donating to a registered 501(c)(3) organization to qualify for the deduction. These are typically nonprofit organizations like charities, churches, and educational institutions. So before you open up your wallet, double-check that your chosen organization ticks all the right boxes. It's crucial to do your homework. And remember, keep those receipts. They are your proof. Just like with any other tax deduction, you need proper documentation to back up your claim. So hold on to those receipts, thank you letters, and bank statements. They are essential. You never know when the IRS might come knocking. Being prepared is always the best strategy. Now, let's say you're really feeling generous and want to maximize your charitable impact. There are several strategies you can employ to ensure your donations go further and also benefit you financially. Did you know that you can donate appreciated assets, like stocks or real estate, directly to charity and avoid paying capital gains taxes on the profit? This method not only helps the charity, but also provides you with significant tax advantages. Let's say you bought a stock for $1,000 and now it's worth $10,000. That's a substantial increase in value. If you sell it, you'll owe capital gains taxes on that $9,000 profit. This can significantly reduce the amount you have available to donate. But if you donate the stock directly to a charity, you get to deduct the full $10,000 from your taxable income and avoid those capital gains taxes altogether. Talk about a win-win. This way, both you and the charity benefit more. Another strategy is to bunch your donations. This involves consolidating your charitable contributions into a single year. Instead of giving smaller amounts throughout the year, consider making a larger donation all at once. This can be particularly effective if you have a year with higher income. This can help you exceed the standard deduction threshold and potentially bump you into a lower tax bracket. By doing so, you maximize your tax savings while still supporting your favorite causes. And lastly, don't underestimate the power of volunteering your time. Your time and effort can be just as valuable as monetary donations. While you can't deduct the value of your time on your taxes, volunteering is a fantastic way to give back to your community and potentially meet other like-minded individuals who are passionate about the same causes. It can also provide personal fulfillment and a sense of accomplishment. Plus, it just feels good to make a difference, right? Whether through financial contributions or volunteering, your efforts can have a lasting impact. One last thing to consider is setting up a donor-advised fund, or DAF. Think of it like a charitable investment account. You can contribute cash, stocks, or other assets, and the money grows tax-free. Then, you can recommend grants to your favorite charities over time. DAFs are a great option if you want to be strategic with your giving or if you have a significant amount of money to donate. Plus, they offer some pretty sweet tax benefits, like an immediate tax deduction for your contributions. Remember, donating to charity is more than just a tax strategy. It's about making a real difference in the world. So find a cause you're passionate about, do your research, and give generously. By the way, if you're enjoying these tax tips, don't forget to hit that subscribe button and ring the notification bell so you don't miss out on future videos like this one. Okay, let's talk about something that might not be the most exciting topic but is absolutely crucial when it comes to taxes record keeping. Trust me, you don't want to be scrambling for receipts and documents come tax season. It's like trying to find a needle in a haystack, but the haystack is on fire and the needle owes you money. The IRS requires you to keep accurate records of all your income and expenses. This includes things like W-2s, 1099-S, bank statements, credit card statements, receipts for business expenses, and any other documentation that supports your tax return. Think of it this way. Keeping good records is like building a rock-solid case for yourself. If the IRS ever comes knocking, you'll have all the evidence you need to support your deductions and avoid any unwanted surprises. And let's be real, nobody wants to pay more taxes than they have to. Now, the good news is that keeping track of your records doesn't have to be a nightmare. In fact, with the right system, it can be quite manageable and even stress-free. There are tons of tools and strategies out there to make your life easier. From traditional methods to modern digital solutions, the options are plentiful. You can go old school with physical folders and filing cabinets, or you can embrace the digital age with apps and software designed specifically for tax record keeping. Each method has its own set of advantages. Personally, I'm a big fan of going digital. The convenience and efficiency it offers are hard to beat. Apps like Expensify, Mint, and TurboTax Self-Employed can help you track your expenses, categorize transactions, and even generate reports for tax time. These apps are designed to simplify the process and save you time. Plus, you'll never have to worry about losing a receipt again. Digital records are easy to store and retrieve. But hey, if you're more comfortable with pen and paper, that's totally fine too. The key is to choose a method that you find easy to maintain. Just make sure you have a system that works for you and that you're consistent with it. Consistency is crucial for effective record keeping. The key is to find a method you'll actually stick with. Whether it's digital or physical, the best system is the one you use regularly. And don't forget about those digital receipts. They can be a lifesaver during tax season. Create a dedicated folder in your email or cloud storage account and save all your electronic receipts in one place. This will make it easier to find them when you need them. Trust me, your future self will thank you. A little effort now can save you a lot of hassle later. One of the biggest mistakes people make is waiting until the last minute to get their records in order. Don't be that person. Make it a habit to organize your documents throughout the year. Another common mistake is not keeping records long enough. The IRS recommends keeping tax records for at least 3 years, but it's generally a good idea to keep them for at least 6 years just to be safe. And lastly, don't underestimate the power of a good shredder. Identity theft is no joke, so make sure you're securely disposing of any documents containing sensitive information. Remember, staying organized is key when it comes to taxes. By keeping accurate records, you'll not only save yourself a ton of stress, but also potentially thousands of dollars in the long run. And there you have it. Those are my top strategies to help you lower your taxes in 2024. Remember, tax laws are always changing, so it's crucial to stay informed and adapt your strategies accordingly. If you found this video helpful, please give it a big thumbs up and subscribe to my channel for more personal finance and tax tips. And don't forget to hit that notification bell so you never miss an update. As always, I'm here to help you make smarter financial decisions. So leave your questions and comments down below, and I'll do my best to answer them in a future video. Until next time, stay informed, stay proactive, and keep crushing those financial goals.